Hello and welcome. It continues to be an eventful period for markets, with a shift in the narrative from retail bank failures and their subsequent rescue to the possible but unlikely technical default of the biggest of all debt issuers, the United States of America. So at the time of filming, there has been no resolution yet to increase the US debt ceiling, with the country facing the potential risk of a technical default and the inability to repay its current debt or to issue new debt. Our recent blog on the topic, found on the Nutmeg section of the website, provides some further understanding of the political deadlock between Democrats and Republicans, again causing delays. Amid much media speculation about US government default, bond markets have remained relatively calm, with the expectations that President Biden will likely manage an agreement with the Republicans before the 1st of June deadline. Since our last monthly update, when we highlighted and implemented a more constructive outlook for bonds among our portfolios, the task of the different central bankers has arguably become harder still. The Federal Reserve, the Bank of England and the European central banks, they're all facing some renewed difficulty to balance a soft landing of their economies with inflationary pressure and pushing them to increase rates even further. In the US, the Fed is seeing a labor market that remains historically tight, and even though we've seen a slight uptick in unemployment recently, the overall labor market remains highly supportive of consumption and for economic growth in general. US inflation is trending lower, but remains at an elevated level, and in particular core inflation, so removing more volatile components like food and energy, surprised slightly on the upside and remains a conundrum for Chair Jerome Powell and other board members. If they pause in their policy of rate increases, they risk missing their long-term inflation target and could lose some credibility, with the risk of inflation moving higher for longer. On the other end, a continuation of rate hiking policy could end up pushing the economy into recession. Rate increases can take time to impact an economy, and the risk is that further hikes might become damaging and might have been unnecessary. The Bank of England is facing similar difficulties, and in its recent forecast publication, the bank made the biggest revision on record to its forecast, and the GDP number published afterwards for the first quarter of 2023 was already a small upward revision to this forecast. Therefore, with the level of inflation, and especially core inflation, stubbornly resistant, and an economy defying recent pessimistic forecasts in terms of recession, the task of the Bank of England is perilous. The Monetary Policy Committee needs to bring back inflation, which doesn't seem yet totally under control, by increasing rates further while managing a soft landing for the economy impacted by the biggest rate increase in over 40 years. Thank you very much for watching.